There's a huge shift in Canadian real estate right now, and specifically an increase in foreclosures and a lot of news. I mean, a ton of news about exactly what's going on in the Canadian real estate market. And just like everything else, if it bleeds, it leads. The question is, which news articles and which headlines are important and which ones are just noise? Well, that's what I'm going to go through in today's video as we discuss the changing Canadian real estate market. And yes, it's changing. Things are getting a lot different from the perspective of whether it's the right time to buy or sell, and foreclosure numbers are up, and it's getting harder to sell cottages and so on and so forth. All of those things are happening. But the question is, how much? And where's this whole thing going? Is it going to get better? Is it going to get worse? Are we at a pause, or are we nearing the crash? Well, I'm going to get into all of that stuff, but before I do, my name is Nolan Matthias. If you're new here, this channel is all about Canadian real estate. Now, you may look down and say, hey, I thought I subscribed to Nolan before. Maybe you did, maybe you didn't. But if you thought you'd subscribed previously and you aren't subscribed right now, that's because this is a new channel dedicated to Canadian real estate. So if you want this kind of information, make sure you click that subscribe button. And by the way, the old channel is now focused on wealth building and general financial advice. So make sure you go check out that one as well and subscribe to it as well if thriving and giving and being richer is your jam. So I want to jump right in, and we're not going to mess around on this video. Other than to say, by the way, that $27 deal on my Rate Secrets course that gets you the new course in the future and all that stuff, that's still available. So go to ratesecrets.ca and check all that out. But for now, let's talk about what's going on in the Canadian real estate market, because there's two videos right now that are going absolutely viral. And these are both with respect to the Toronto real estate market. The first was released about 3 hours prior to the filming of this video by my good friend Tom Story. And it is about the Toronto real estate market and the fact that it's changing and that expectations of sellers are now changing. And he specifically talks about the fact that people aren't necessarily expecting to get multiple offers anymore. And a lot of homes are now being sold for less than the listing price rather than way above the listing price. And this is no doubt partly due to the fact that there's an influx of listings compared to number of sales, which I'll get to in a minute. The other video that's going absolutely crazy, and this one is nuts, is from my good friend Jordan Skrinko, who runs the Pre-Condo YouTube channel. This video, Toronto Foreclosures up 400% and condo market crashing, has 77,000 views in the last 2 days. This is one of the highest performing videos I've seen in the last 3 years on the Toronto real estate market. It is absolutely insane that this video is getting that many views. And I'm going to go through a little bit of details on what's going on in the Toronto market in this video and what he's talking about, but make sure you check out the Tom Story and the Jordan Skrinko videos, because they're both full of really good information. And by the way, Jordan talks about what's actually happening with respect to foreclosures in Toronto, and it's a very interesting story. And it's not necessarily what you would think from the headlines that you're seeing in the news reports. So I want to go through and put a more national frame on this, because this is very much a national real estate channel. And I want to talk about everything that's going on in the market, because yes, foreclosures are up, delinquencies are up, and it's getting harder to sell recreational properties. And all of those things are a sign that we're kind of hitting that point in the real estate market where things are getting a little bit too expensive. There's a little bit too much volatility. And the next 3 to 6 months will tell us exactly where the market's going to go and how bad it's going to get. But the fringe buyers, the people who are over leveraged, have too many properties, maybe bought using mortgages and funds from private lenders, are all starting to feel a little bit of pain here. But the more important piece of the picture is with respect to the vast majority of people and what actually has to happen in order for the market to get really bad. So I want to show you first the residential mortgage industry data dashboard. This is from CMHC, and this is probably the primary source for delinquency data. And I just want to show you the delinquency data because it tells a really interesting story, a different one than the headlines. Now, here's what it says. Arrears on mortgages under 30 days is at about 1.93%. Now, this is a big number. This isn't typically where you want to see the arrears data. This kind of indicates that things might be getting a little bit worse. But arrears that are at 30 to 60 days, this is where it starts to affect your credit, are still at only 0.14%. And then 60 to 90 days at 0.5%. And then over 90 days, 0.16%. So the arrears data is still very good. There is not a lot of mortgages in Canada that are in serious delinquency. There's a few, I'll show you those Toronto numbers in a second and talk about how it could possibly be that delinquency numbers look like this, but foreclosures are up 400%. But I just want to show you the distribution of loans in arrears over the last couple of years, because what this shows you is that over the last couple of years, delinquency rates aren't really that bad. Yes, they're higher than they were in 2022, higher than they were in 2021. But if you look back to the pandemic and the beginning of the pandemic, when things got a little bit rough for a lot of people, this was when people started to really get affected by not having jobs. You can see that the numbers aren't that bad in comparison. Now, could this get worse? Yes, absolutely. I'll talk about in a second what could make that worse. But for the most part right now, we're just kind of hitting that lull in the market where people are in that wait and see sort of mindset, and they're going to see where the Bank of Canada goes, where the economy goes. We've kind of hit that point where rates are actually starting to do their jobs. Now, I want to show you the TREB numbers because those foreclosure numbers are up 400%. I don't have the actual data on that. I don't have the images for that. Make sure you go check out Jordan's video to see those. But the story there is that foreclosures, forced sales, as they like to call them in Toronto, are at about 150. Now that is up 400%. But in the entire Toronto real estate area, there's about 154 sales, which is not an awful number. It's just significantly higher than before. And the majority of these forced sales, according to the Toronto Sun or the Toronto Star, or sorry, whatever newspaper is out there, I can't remember, they've got it behind a paywall, are primarily from private lenders. So private lenders are the types of lenders who lend to people who perhaps shouldn't be getting a mortgage in the first place. So it's not surprising that these are the ones that are finding themselves in foreclosure. And what that tells us is that the fringe borrowers are starting to feel the pain. It doesn't tell us necessarily that the prime borrowers, most people who got mortgages in Canada, are feeling a lot of pain yet, although they are. But the ones that were on the fringe are definitely not able to make their payments and are finding them in situations where they're just handing back the keys. I also want to show you the Toronto Real Estate Board's data here and show you the difference in sales versus new listings. So in September, we saw new listings jump substantially, especially compared to other years. But we also saw the sales come down substantially. So in the last couple of years, when you saw sales go up, you also saw listings go up. Now we're seeing sales come down and we're seeing listings go up. So that is very much an indication that we're starting to see some settling in the market, and in a lot of ways, probably the market waiting to see what happens. Is this going to get worse? Is it going to get better? We don't know. Everyone's just hanging out on the sidelines to see what the story is going to be. And this isn't true for just Toronto. BC is seeing the same sort of thing, with the BC Real Estate Association saying that sales activity is being impacted by the higher cost of borrowing. There's no surprise here. And in general, Canadian real estate has just been declining. It's not having the same jumps that we've been used to the last couple of years. The Canadian Real Estate Association cut its forecast for home sales and prices this year. And ironically, they did this at a point in time where it was going to be clear that they weren't going to hit the previous numbers. Now, this was the second reduction in the forecast from the Canadian Real Estate Association this year, and they also reduced the forecast for next year. Again, higher borrowing costs, less borrowers, leads to less sales and potentially lower prices or flat prices. And that's the real question here. Where are prices going to go? We're seeing a significant amount of stress show up in the Canadian bank mortgage data. So in other words, as they're reporting each quarter to the public markets, we're seeing more and more, I wouldn't call it negative data, but data that could be construed as data that is suggesting things could get bad. For example, RBC, the country's largest mortgage lender, disclosed that 43% of its Canadian residential mortgages had an amortization period of longer than 25 years. That's up 40% from a year earlier, which means that pretty much all the mortgages that have longer amortizations, or a large majority anyways, are from variable rate mortgages with fixed payments that have negative amortizations. And this is one of two major problems in the Canadian real estate market right now. One being all the mortgages that are coming up for renewal, both the variable with fixed payments and the fixed rate mortgages that obviously have fixed payments that nobody's really thinking about right now, but in the next year or two are going to come up for renewal and cause a significant amount of payment shock. And both of these types of mortgages are going to cause pain for consumers, and it's going to be a realization that leads potentially to the market turning, aside from the fact that we've got an inventory crisis and all the other stuff. But there's one other issue that is glaring in the Canadian real estate market, and that is this. It is inflation, and more specifically, unemployment, and how the battle to get inflation back to 2% could have a very drastic impact on unemployment. And that could ultimately lead to some serious real increases in the amount of forced sales and foreclosures. Because here's some data from RBC. This is their forecast, and they're showing, I'm going to have to zoom it out here just a little bit. They're forecasting that in addition to the 0.5% increase in unemployment that we've seen since the beginning of the year, we're going to see an additional 1.1% increase in unemployment. Now, the 0.5% increase in unemployment is a huge increase. That is not something that you want to see in an economy. 0.5% is a lot of jobs. 1.5% from January of this year to Q4 of 2024 is an insane number of jobs. And the problem that creates is in the event that those people can't afford their mortgages, don't have an emergency fund saved, well, that could lead to a significant amount of foreclosures with prime borrowers. So the type of borrowers who got the best types of mortgages at the best rates have mortgages coming up for renewal and inadvertently around the same time start to lose their jobs. Now we've seen RBC is laying off people. We just saw Scotiabank announce that they were going to lay off 3% of their global workforce. So there are layoffs coming. Profitable companies that tend to do well in Canada, regardless of what the economy looks like, start laying off people. That's usually a sign that those layoffs are going to start coming to other industries. So if these forecasts from RBC start to come true and unemployment numbers start to go up, and keep this in mind, you got to watch unemployment numbers. Employment numbers matter too, but they aren't the same data. But if unemployment numbers start to go up another 0.5% or 1%, that is a lead indicator that we're going to start feeling a lot of pain in the real estate market. Now, if RBC is wrong on this forecast and everything kind of stays the same, we're probably going to be okay. But if those unemployment numbers jump substantially, we're going to be in trouble. And keep in mind that it's likely the unemployment that will lead the inflation numbers to come down as there's less money available in the economy to spend and people start to tighten their belts. So if you're somebody who's watching the real estate market right now, trying to figure out if you want to sell a property that you have available to offload or that you may not be able to make the payments on in the future, this is the piece of data you need to be watching. This is the one that comes before the inflation numbers. You likely won't see inflation hit 2% until you see unemployment increase. And if you want evidence of that, 5% unemployment in January to 5.5% unemployment in Q3 of 2023. Well, look at the inflation numbers going from 5.1 down to 3.8. Those two things are not only correlated, but they're causal. Unemployment leads to the lower inflation. Oh, and one last thing, if you are looking at getting into the market, this could be a good opportunity to buy, especially if you're buying with the long-term in mind. Now, I know it's scary, interest rates are high. You're probably going to find yourself in a situation where you're looking at the market going, well, what if it crashes? Or what if it continues to go up? Well, at the end of the day, 25 years down the road, regardless of if you bought at the top or the bottom, it isn't going to matter. Any crashes, any increases are just going to be a blip on the radar. Look at the US in 2008. If you'd bought in 2006, held onto the property, you're well above what it's worth now, and you're probably more than halfway towards paying it off. Just make sure that the house that you are buying is one that you can afford and you feel 100% confident in your employment and the fact that you're going to be able to continue to be able to make the payments. And if you are a single income family or a single individual, make sure that you've got at least 6 months worth of those mortgage payments saved up. And if you are a multi-income family, make sure you have at least 3 months. Oh, and if you want to check out those videos from Tom and Jordan, make sure you check them out right here. And check out this one for the latest on what's going on in the Canadian real estate market from my channel.